Hey guys, welcome to The Syndicate, the show where we get the world's top investors to talk about the future and much more. Today, I think we definitely got one of those guys, Ajay Chopra, on the program. Thanks for coming today, Ajay.
Glad to be here, Matt.
Yeah, and I'm excited to have you here as well. Here for you is San Francisco, and that's something we were talking about a little bit before. Let's get into that. Uber and Lyft are planning on going public next year. I imagine San Francisco is gearing up. What's the scene like these days?
It's pretty exciting, and I would say also frothy. There's been a buildup of multiple unicorns, a couple of hundred of them at last count. And it feels like now is the time for some of these companies to actually hit the public market and test themselves against public analysts, who like to talk not just about valuations, but also about things like profit. You remember that, and sustainable growth that is generally going to generate cash flows in the future, which is what public investors care about, particularly in the market, in the public market, such as it is right now. So it'd be pretty interesting and exciting to see that happen. I think it'll be sort of validation of the entire on-demand economy. Remember that from like 6, 7 years ago? There was a lot of excitement about that, and not too many companies panned out. Only the ones in the ride-sharing area and delivery services seem to have really built solid businesses. So this will be a validation of that entire market segment, the Uber and Lyft IPO. So that's, it'll be exciting to see how that goes. Fun fact, by the way, both those companies are our anti-portfolio.
Ooh, that hurts.
No,
Which came
no
first?
kidding. So it was Uber that came first, and Travis Kalanick was actually on a board with me, a company called Crowdflower. And I remember meeting him at Townsend Cafe, right near the harbor in San Francisco. And he showed me this app, and he said, "I'm investing in this company, and I've got this guy from Foursquare to run it." And at that time, it was called Uber Cab, and they were running black car limousine service, if you may recall, in the early days. And my reaction was, "Oh my God, this is just another elitist service in San Francisco. This is going to go nowhere." And of course, didn't see that it's going to pivot to P2P car sharing over time, and they did a great job. And then we did the same at Lyft. We looked at Lyft when they were Zimride, if you remember that. They were essentially doing car sharing services for colleges. And at that time, we just didn't see how that would pan out, but they also pivoted to P2P car services. So that became pretty exciting over time. Hey, you win some, you lose some. That's what venture is about.
It is. Looking back, is there anything that you realized or should have realized from the meetings?
I think, honestly, if Travis had been CEO at that time, I would have just definitely invested in it. He was an investor in Uber at that time, and he had brought in Ryan Graves to be the CEO. And it was not clear that Travis would be committed to the company, which he did later, as you know. Because I had a personal relationship with him, if he had been the CEO, I would have probably just invested on that. So sometimes those things matter when you're looking at very early stage companies.
So you had a reason at least. So there's going to be thousands of new millionaires created, all a lot in the tech area, especially San Francisco. The area is already super inflated, so to speak, when it comes to pricing. Is there a huge buildup happening right now?
Well, I think that there is so much wealth that has already been created with the inflation of stocks and public companies. If you look at except for the recent correction in the last couple of months, if you look at the valuation increase over the last 4 years of Google, and if you look at the valuation increase of Facebook and so forth, there are multiple millionaires that have been created during that period. Who have successfully bought properties, in and around the area, particularly in San Francisco. The value of condominiums there has just skyrocketed. I think this will just add to that. I think that the level is already so high that I'm not sure that you're going to notice a major change in that activity. In my opinion, there might be a blip when 6 months after the IPOs, when some of the employees are able to sell. But I think that the level is already so high that I doubt that it's going to be a particularly noticeable thing. The Valley is such a robust place. The company is going public, large and small, all the time. So it does not have to be a $120 billion IPO, in other words.
Do you know if either of the companies are profitable? I know you said that of the massive crop of on-demand companies, it was kind of like the delivery and the transportation companies, the only ones that seem to make it. But I would say a lot of them, I don't know how sound the economics are for those models.
From what I understand, they are profitable in certain cities, where they have, density of, service on both sides, demand and supply. I believe in newer cities where they don't have that density yet, they're still not unprofitable. But I don't have any inside information on either of those companies.
Okay. It seems kind of like the army that tries to fight every battle. If you have to fight every battle and you have militaries in every area, eventually you kind of run out of forces. I don't know. We'll have
I
to.
think that's interesting, but the to that point, by the way, I think Lyft is being smarter.
Oh, definitely.
They have picked cities where there's higher probability of achieving that density on both sides, and not necessarily being everywhere. So it'll be interesting to see how the market receives those two IPOs, and I think there's also something about which one goes first, because there's a pent-up demand from the public investors for this type of high growth company in this type of service, on demand service. So it may well be that if Lyft, that I think filed like a day before or so confidentially, confidential filing, if they go out first, it may be that they get a pretty good reception, and then obviously people would then compare their economics in each city to what Uber's are, and that'd be pretty interesting to see how that plays out.
Yeah, I know. I would personally rather have a share of Airbnb than either of those
Probably
two.
true. Probably true. Yeah.
Have we heard anything about them yet?
Well, they apparently seem to be also moving the same direction, and so I expect all three of them to be out in 2019.
Wow, that will be quite the year. How do you think about the fact that there are so many companies that have been staying private longer?
Well, being public is not an easy thing. I was with a public company, as you know. I founded a company that went public, and was on conference calls with analysts every quarter. That's a tough thing. You get hard questions, and they look at every metric purely from a financial standpoint. And unfortunately, the focus with the analysts is in fact short term. I mean, they're trying to see and benefit from shorter term movements in public equities. So you're in a glass house, and you're constantly being measured every 90 days. So if a company can continue to raise capital in private markets, it's not a bad thing, till it's in a situation where it can produce stable revenue growth as well as profits. It used to be, by the way, in the era that my company went public, to go public, you had to be profitable, right? I mean, people don't remember that.
You had to be a real company,
You had to
essentially.
be a real company. So it was only after 2000 that this idea that companies that go public don't need to be profitable was born, right? So after the big bubble, tech bubble in 2000, and then since then, that whole idea of profitability has sort of gone to the wayside, where lots of companies go public without being profitable. So I think being public is not easy. You need to show sustainable growth. You need to show eventually profitability and cash flows. So for companies who say private is better in a way, because if they can get private capital at increasing valuations, and these days the rounds are larger in many cases than public rounds. So it's not like there's not access to large amounts of capital to grow. And plus, you don't have to report every 90 days. You only have a small set of board members and investors to report to from time to time, perhaps even annually to investors, and maybe quarterly to board members. And then, because there's secondary market now available on the private side, it's liquidity is possible. So it's not as if you can't achieve liquidity. So that's why these companies have stayed private for a very long time. They can get increasing valuations. They have access to capital, and they also have access to liquidity, which is what you need to go, in a public market. So But eventually, all of these companies at some point in time either have to be acquired or go public, because that's when the larger set of people, investors, and in particular employees, can achieve liquidity and also have access to much easier liquidity over time, even after they depart the company.
But is there at least an argument to be made for changing the paradigm? So a big problem I see right now is the public market essentially incentivizes businesses to sacrifice the future for the here and now. I've seen polls of top public market CEOs saying something to the effect of 60 to 80% said they would be willing to forego investing in something with guaranteed long-term growth if it meant that they could have better numbers next quarter, because that's how they're incentivized. And I think we're recognizing now that the public markets are broken very fundamentally in the way they look forward and incentivize future growth. If I had a company, whether or not I took VC money, I would want to stay private, run the company, and find a way to turn that into something long-term sustainable and still make it work for the employees. Do we need to have a system like Eric Ries is working on with a long-term stock exchange, where instead of trading every second or every microsecond, we have trading every quarter, something to spread things out so companies can think farther down the line?
Yeah, I think it's definitely something that has got. By the way, it's got multiple angles to it, right? So the angle that you're describing is absolutely true. When I was running the public entity, I would often talk about longer term and sort of paint a vision of how we're going to be performing over the next year. By the way, just the next year was long term for
Yeah, I was
public
gonna I was
markets.
gonna say right there that makes the
So,
point.
and sometimes people would give you that benefit, particularly if you had performed fairly well over the last several quarters, to make the right investments and such. But the nature of the beast in public markets is accountability, and unfortunately, it's moved to short term. So there's lots of arguments to be made for staying private. But let me tell you one thing that may change your mind. To the extent that there is not sufficient liquidity for everyone, um, in effect, you are benefiting the top 1% or the top 5% when companies stay private longer. Let me explain to you what I mean by that. Uber was valued at some 40 billion a couple of years ago, right? And now potentially it's going to be valued at 120 billion. That $180 billion in valuation increase over the last couple of years has accrued primarily to people that were in the top 1%, because they had access to SPVs to make investments at that $40 million valuation a couple of years ago, right? And they benefited from this increase in valuation. Whereas if Uber had gone public at 40 billion, then that valuation increase would accrue to you and me and our 401k plans, right? So I think that's a very interesting point of view to look at, that this unicorn staying private for a very, very long time is accruing to the benefit of a smaller percentage of the population, which is also not healthy. So there are positives and negatives to companies staying private longer.
There definitely are, but from the company, from the startup perspective, they're thinking about that in terms, they're not thinking about the big picture of how do we help society be better, where they're thinking about how do we succeed and how do we help our employees succeed. With this new SoftBank Vision Fund and the fact that they want to put a new one together every 3 years, can you just not just sell half the company when you want to go public and then distribute that out to employees, investors, et cetera, and then own the company and be private and have Masa owning half your company? Is that not the future of venture capital?
Perhaps, by the way, I think if they were to distribute out half the company to employees, that would be something. I don't know of any company that has actually done that. Uh,
Not half the company, sorry. So
yeah,
basically half the stock options that the employees had. So
yeah. Actually, I don't know of any company that has done that either. So, I think that in a way, if you think about it, many companies are probably they probably want to hang on to their employees, and one way to do that is to incentivize them with stock options as they do. But another way is, if the liquidity is delayed, perhaps a lot of those people would stick around to see where it plays out. Because keep in mind, if you leave a company, you typically have to exercise those options within 90 days. So it is a retention element to it. So yeah, I'm not sure that everything there is completely upfront and pure.
Understood. Understood. So part of it is kind of holding the gun to the head, so to speak. Not exactly
So to
those
speak.
terms.
So to speak. Yeah.
What areas are you most excited about these days in terms of technologies, industries, et cetera?
Yeah, so I think we're seeing some interesting moves in brands that'll be built that are direct to consumer. We feel that brands that pay particular attention to having a very clear and authentic value system will be very well received by particularly millennials. So a couple of our companies, Bulletproof, which you may or may not have heard of, that is
Oh, you guys are in Bulletproof as well.
yeah, we were the very first and original investors in Bulletproof. The company was actually founded by an EIR, executive in residence, David Asprey, who was with us. So we were able to get in very early, and we have maintained our ownership over the years. Yeah, so that company, essentially 5 years ago, evangelized the idea that the food pyramid was upside down. It was carb heavy and such. And David, started to write what were at that time fairly controversial blog posts. Now they're fairly well accepted. Everybody's on a keto diet these days. So he evangelized the keto diet and its benefits, got a huge following. And then when his followers started to ask him about ways to adhere to the diet that he was proposing, he started to sell products against that, including buttered coffee, collagen protein bars, and such. But his point of view is extremely authentic. If you look at him on social, if you look at what he says on social media and otherwise, and so that is extremely appealing. He's himself a practitioner of what he's talking about. So we like those types of authentic companies that stand for something and have a value system. Another one of the companies, Thrive Cosmetics, which I'm on the board of, was started by a young female entrepreneur, Carissa Bardner, and she actually, the company's origin was because of a bad experience she had with one of her friends, a very young friend in her 20s who was afflicted with cancer. And so when women get afflicted with cancer, they are advised not to put on cosmetics on their faces because cosmetics are not, they're not very good for you in general. They've got chemicals. So she started to experiment with vegan plant-based cosmetics and built out this company called Thrive Cosmetics. And she called it cosmetics rather than cosmetics because it was cause-oriented play. And that company scaled tremendously. It is almost 10x since the time we invested about a year and a half ago. She is donating one product for every product that she sells to women's causes, particularly women that are afflicted by various different diseases. So that has caught the attention. If you look at the on social media, in particular on Facebook and Instagram, she's got a tremendous following because she stands for something. So I think we believe that new brands will be created that stand for something authentically, and we look at those as a very interesting investment opportunity on the consumer side. On the B2B side, we believe that there has been massive disruption because of cloud and mobile, and we believe that there's going to be an equally big disruption because of the use of NLP and artificial intelligence. So we're looking for opportunities in areas there. I have personally been very interested in autonomy and have an investment in that area. So we believe that as as an example of artificial intelligence, I think autonomy is going to be a massive transformation and change, in the market in the next 10 years or so. So those are some of the areas that we're looking at actively.
There's a lot of things to unpack there. I'm glad you brought up the direct to consumer. My background is e-commerce, specifically Amazon, and I
Great.
have a lot of people ask me about e-commerce and direct to consumer and brands. And I think we're headed two ways. We're headed very much to one of two extremes. The luxury high-end products for the things that you're very passionate about, your hobbies, your interests, etc. And everything else I feel is getting commoditized. I don't care what brand of mattress I have, what brand of shoes I have, what brand of toilet paper. A lot of products that if it's not something for me, it's something for everyone. But on those certain specific things, I think you're right. Those cause oriented, deeply authentic brands are very interesting. I can tell that you've known Dave for a while because you call him David. So it's one of those things. It's one of those things. You build that relationship. What's the
Yeah.
best way to meet those great entrepreneurs ahead of time?
Yeah, so the way we prosecute our business is by becoming proactive about points of views. So, for example, in this value focused brands, my partner Patricia Nakash, who runs our consumer practice, she had written blog posts and been on panels and such, talking about exactly this point of view. Is how brands need to stand for something and stand for something authentically. And so what happens is when we are out there evangelizing that point of view as individual investors, whether it's on panels or through blog posts and such, or postings, entrepreneurs become aware of it and they reach out to us. So we get a lot of flow. Now, I have to say that not everybody is authentic in what they're doing when we look at them. So selectively, that becomes a pretty interesting way for us to get access to some of the entrepreneurs. Obviously, once we have made investments in the sector, those investments, especially the ones that gain a lot of notoriety, such as David's Bulletproof investment, it starts to show examples of where our interest is, and we get other entrepreneurs reaching out to us. The interesting thing about Thrive Cosmetics, because I use that as an example, Carissa Bardner, who is the founder of Thrive Cosmetics, used to work for Dave at Bulletproof as a product manager. So, we had special access to that because we knew that she was founding that company through the people at Bulletproof and other folks. That's something that Trinity has done very effectively over years and years. If you visit our office in Menlo Park, you'll see pictures of entrepreneurs all over our walls, and all of them are actually repeat entrepreneurs. So that's something we value a lot. Either they're repeat entrepreneurs or they have formed multiple companies with us or referred companies to us over years. So we see that as a pretty valuable way for us to get deal flow, authentic deal flow from high quality people.
You build your own little mafia. How do you think about
It's actually a big mafia. It's not little anymore.
That's not little anymore. I like it. That's even better.
When
You
you're in
can
business for 32 years, right? I mean, you build a pretty large network of people. So yeah.
You're like the godfather at this point. How do you think about first time founders versus repeat founders? I know the repeat founders, people love them because they're proven. A lot of times they have the team, they've got the track record, they've screwed up enough times to know what they're doing. But if they've been successful, they also have less of that internal drive that I got to get out of this ramen noodles and tuna fish mentality. They've already are somewhat set. How do you think about the dichotomy between those two?
I think that we have seen success with both types. The good thing about the repeat founders is exactly as you mentioned, that they have been through it. They know what the pitfalls are. They're more comfortable with their success, their strengths and weaknesses. So they very quickly hire people around them that complement their strengths and weaknesses. But you're right. Sometimes they may not be as hungry. We have noticed that many times, and we try to assess that at the point of making that second investment or investing in a follow-on company that they may be doing. On the other hand, when we are working with first-time entrepreneurs, we love their energy, we love their hunger. We sometimes have to do more work to convince them as board members on building a team around them that would be complementary. I have lots of dinners with them and talk about our own experiences as entrepreneurs. I think that's one thing nice about Trinity. Many of our partners have been entrepreneurs, have been in their shoes before, so it can talk authentically about the mistakes that we made and the stages that we went through. So anyway, so I think that is what I feel are some of the differences between the two. But we have seen great successes with both, without doubt. So we look for both types of entrepreneurs.
It's probably the way to go. It's helpful because you guys are also both types of entrepreneurs.
True.
So with Uber and Lyft, and now you brought up autonomy as well. Where do you see autonomy coming in? Do you see that as something that the existing players are going to implement, something that a company like Google or Waymo plugs into, something that maybe Uber is the leader in? How do you see autonomy playing out?
Yeah, so the way we see autonomy play out initially would be in closed campuses. I think the regulations for autonomy are going to take a quite some time to sort out. I don't believe that autonomous vehicles in a couple of years will be a technology problem anymore. It'll be really a regulation and an acceptability problem. And what I mean by acceptability is, if a car actually hurts a person, how is that perceived versus when a driver behind a wheel hurts a person? That's something that I think the society has to come to terms with. And also regulations because of that. So I think that initially, what we will see is autonomous vehicles in closed campuses. That is already happening. We have there've been tests going on at Santa Clara University here locally. There are companies that we have met that are deploying these in resorts and such, where the vehicle is moving at a slower pace on designated paths. So I think we see that as the first step. Then I think what we'll start to see is adoption in commercial vehicles such as trucks on freeways. So perhaps there is one driver for several trucks that are moving in tandem. That I think will be an interesting approach, and particularly trucks being driven overnight on long routes. One truck leading several trucks, one truck with a driver, other trucks without a driver, that sort of thing. And then there'll be fleets. And I think that's where the battle is going to be between whatever the people like Waymo are doing, and also the people that have access to consumers that are currently using manual fleets such as Uber and Lyft. It'll be interesting to see how that plays out. My feeling is that the advantage is going to shift to those people that actually can manufacture the technology and also the automobile itself. So I think there'll be very interesting relationships, and you've already seen that with GM and Cruise, because the cost of manufacturing those automobiles will be much smaller. And I think there'll be alliances formed because on one hand, people like GM and Cruise and also Waymo have the technology, but on the other hand, Uber and Lyft have aggregated the demand, right? So I think there'll be interesting relationships between those companies, I believe, over time.
But couldn't you say Google's also aggregated the demand? So all they would have to do is they've already have maps turned on. They could basically say, hey, by the way, we created an autonomous account for you guys. If you want to ride, just click here. Can't they kind of cheat the system?
Yeah, I think the big decision that Uber will have to make is whether to get into the fleet business themselves or not, right? So, it's possible that they may do that. And this is why I was mentioning earlier, it may well be that the advantage belongs to people that have the technology, it can actually bring it to market, or the people that have aggregated the demand already, right? So I think that Google is probably in a pretty unique position and they're already experimenting, as you know, with Waze. Within Waze, they have enabled ride sharing type of capability, people taking passengers along with them, companion sharing, I would say, maybe a better term. So I think Google is well positioned for that. And then Uber and Lyft will have to figure out whether they want to get into the, into alliances with companies such as GM and Cruise to provide the fleet service. And then the third angle is whether the OEMs themselves will step into it. BMW has been doing experiments with Reach Now up in Seattle, and so have others. They may also want to get into the fleet business. So it'll be an interesting world as it sorts out.
Do you think you'll care what brand of car you're riding in if something's driving you?
I don't think so. I don't think so. It may be for long distances, perhaps, that they may be, but I think most of the ride sharing right now is fairly short distance. And I don't think people will care too much about the brands.
And not the brand of the vehicle either?
Perhaps not. I think except for special occasions. I mean, right now, as you know, Uber and Lyft both have different qualities of services. So depending on if there's a special occasion and perhaps people use vehicles, but I think by and large, for a large number of rides, a large majority of rides, I don't think people would care.
I remember I was reading a sales book one time, and the guy that wrote the book had been called in to do some consulting for a railroad line, and essentially the city was looking at, or the county or whatever was looking at, okay, it's going to cost billions of dollars to upgrade this, and we can speed it up and make everyone's transit time 10% faster. So he came up with an idea, which obviously they didn't implement, but what if we took these billions of dollars and hired the hottest models from around the world, both male and female, and got them nice little trolley carts with champagne and Swiss chocolate and cheese and all the nice stuff, and just had them walk back and down along the train for the entirety of the journey. Suddenly, your journey takes twice as long, or it takes the exact amount of time. It's not faster, but we paid a tenth as much money, and customers were 10 times happier with the experience. And I think it could come down to something like that, where it does just come down to that. Who has that wow factor? And is that the only thing that separates one from another?
So I think, it depends on what you're thinking of in terms of mobility, right? So you have obviously Uber and Lyft that are for generally, I would say, several miles worth of journey. You have other companies that are providing services that are for longer journeys, and potentially there could be public transportation services for that are individualized. But then for very short journeys, you have things like bikes and scooters, for a mile or so. So I think that my feeling is that the convenience will outweigh the wow factor. If you're providing service that is accessible, like scooters seem to be in some markets, right around the corner from you, or have you, or a Lyft or an Uber service that arrives within a couple of minutes. To me, that is more of a wow factor than anything like what you were describing, to be honest. I think convenience will outweigh any of those.
That's table stakes, I
superficial.
think.
Yeah, yeah.
I think they'll all get the convenience down. It's simple enough. It's simple enough once you have the essentially the products in place, et cetera. I think the scooters are going to be pretty revolutionary, though. They seem so beneficial in terms of the convenience and taking cars off the road.
Yeah, absolutely. And it's interesting how they have seen adoption way faster than bicycles, right? That was a bit of a surprise to me because bicycles have been around for quite a while, but the adoption has just not been there. But just the convenience of just stepping on something rather than having to lift your leg and ride on it is it's pretty amazing how that adoption has come in. And plus the fact that they're electric, right? Now the bikes are going electric too, and potentially, maybe that will get more adoption on the bicycle side. But the fact that the scooters were introduced as an electric vehicle, where you could very simply and ride them and find them very easily around the corner, is pretty amazing. So.
Well, not just that, but they're catalyzing either an intense love or hatred from the people. And the one thing you don't want with a product is ambivalence. You want a reaction. Strong, both good or bad means at least something's working. It's like press. But
Exactly.
yeah, I think that's a super interesting space, and I think that's gonna shift a lot of the load off of the grid, so to speak, as we can start getting people out of massive vehicles that they have no business being in and start moving them around cities without that. Because the U.S. public transit just won't work. The U.S. is totally laid out wrong for it to be
It
a
is laid out wrong.
sustainable system.
Most of our cities are totally laid out wrong. I totally agree with you. I mean, we made an investment in a scooter company in Latin America, a company called Grin Scooters. And one of the nice things about Mexico is, they built Mexico City is that they built the city with lots of bike lanes, as you know. And so scooters, I think, will be particularly effective in those types of cities.
Yeah, I think for the future we may need to rebuild new cities though, because it's very hard to retrofit old ones.
Smart cities, right?
Yeah, smarter cities at least, because what we have now is certainly not smart.
Yeah.
So, what technology or industry do you think is the most overhyped, and why?
Crypto.
Okay, outside of ICOs, I was gonna add that one on there because that's the easy one.
Yeah. I think that in terms of hype, I believe that the hype of AI is ahead of where it is today. But unlike ICOs, I feel that AI will eventually fulfill its promise. Let me explain to you what I mean by that. Like almost every company that we meet in almost any sector has an AI slide. So I think to that extent, people are mixing up sort of rules-based computation with intelligence. in their products. But I think there are truly some phenomenal, innovative things that are going to happen over time with AI that will fulfill its promise, unlike the ICO world.
Yeah, overhyped in the short term, underhyped in the long term.
That's correct. Yeah.
Yeah, I think I would definitely agree. I think there are some very interesting use cases for blockchain, but I don't think the ICO system is the way to properly make that happen. I think it's much more you build something and then you get people that are involved in the network actively incentivize them to use the network versus making them to pay to join something that doesn't have any utility whatsoever. It's
Yeah.
yeah.
You have to start with the real problem that you're trying to solve. We have an investment company called Tari that is trying to reimagine the ticketing system, event ticketing system. So, there are at least two problems with event ticketing. One is that there's still a lot of fraud, despite the fact that event tickets have gone digital. But there's also this issue that the venue owner or the event owner does not get any economics from a secondary sale of a ticket, right? I know everybody accepts that, but there's no reason why it should be such. So what Tari's trying to do is to actually, using blockchain, solve both of those problems so that there's traceability and micropayments back to the both the event owner as well as the ticket holder for secondary sales. So that's an interesting application. So that's worth several $1 billion.
Also the artists as well. I was listening to a podcast before, and it's basically you have armies of like essentially micro businesses just buying up these tickets when they go on the market and then jacking the prices up. And basically
Exactly.
Artists do that because Taylor Swift doesn't want to say, I'm selling a $500 ticket. Who wants to come? She wants to say, I'm selling a $30 ticket. Who wants to come? Otherwise the fans hate her. Yeah, it's interesting. I think there's a lot of applications as well in terms of potentially social network type disruptions. But it can't be something where you have to pay to play. It has to be something where you play and get paid to do it in fake tokens, and then over time potentially can change things. But it'll be an interesting area. So I wanna start to wrap things up here, Ajay. What's one thing that you would want to leave listeners with? A quote, a call to action, something to look into before we tell them a little bit more about you and where to find you.
Well, I think we are at the cusp of amazing technology transformation, in my opinion. I think that this whole wave of natural language processing, NLP, cloud services becoming cheaper and cheaper, accessibility through mobile devices on a global basis. I think it's unprecedented. People talked about, in the early part of this century when the computers and the internet were being popularized, that being a wave. I believe this is going to be actually a bigger wave. As an example, we are investors in a company called Branch that is doing microloans through mobile phones in Africa. I mean, the rate at which that company is growing, and more importantly, the rate at which it's making an impact in those countries at the bottom of the pyramid is just incredible. Would not have been possible without these innovations that I just talked about. The way they're able to very quickly assess and determine credit in real time, and provide access to capital on mobile devices just would not have been possible. So my message to entrepreneurs is, hey, this is the time to step out. Lots of opportunities, plenty of capital available. This is the time to step out and form companies. It's very exciting period.
And don't just build things and solve problems for hipsters in San Francisco. There's a lot of opportunities out there and a ton of money that's chasing it if you go for the right thing.
Exactly.
Ajay, this has been fun. Where can people find you and learn more about you and what you do?
I'm on Twitter at Ajay Chopra, just my name, at Ajay Chopra.
And we'll throw links and everything in the show notes, guys. Make sure to check it out. If you've enjoyed this, thesyndicate.vc/iTunes, leave us a review. They're incredibly helpful and help us get awesome guests like Ajay on. Thanks, Ajay.
Great to chat with you.
And cheers, guys.